This is Module 13B, and it's really the second module on budgeting. Last time in Module 13A, we looked at the components of the master budget, and we'll go back to the for practice from that module in just a minute. But today, in this module, we'll be looking at the cash budget. We'll look at the importance of it and also how to put together a quarterly cash budget. In Module 13A, we gave you some information about a company called Dayton Company. And what we're going to do in this particular practice is to go through the sales, production, purchases, and direct labor budget as a quick review of what we did last time. Let's look at the sales budget for this company. And we were selling 120 of A, 120 units, 180 units of B. The price was $50 for A and $75 for product B. And so we can easily calculate the anticipated sales for this particular company. Let's go ahead now and talk about the production budget, because the production budget is the only budget that we're learning that is going to be in anything but dollars. This is going to let us know how many units of each product A and B, that we're going to need to make. So product A, we're going to talk about what we need for sales, for ending inventory, and then talk about what units we already have. So we have 120 units to be sold, 30 to be left over in ending inventory. So we're going to need 150 units. Minus the beginning, looks like we will be producing 100 units of product A in this period. For product B, we do exactly the same thing. Think about what units are needed and what you already have. We're going to sell 180. We want to have 40 left over, so we're going to need 220 units, and we already have 20. So we will be producing 200 units. So very important on the production budget to recall that it's always in units of production. Let's go to the purchases budget, and recall from last time that when we do a purchases budget, we want to do the all the calculations in terms of pounds or gallons or square footage, but not dollars. If you'll notice here, the dollars are not added to the calculation until the very last step. So in terms of what we're going to need in the way of pounds, we're going to need pounds for production and pounds for ending inventory. We had two products. So we have product A. We're making 100 units and each requires 2 pounds. Product B, we're making 200 units and each requires 3 pounds. If we had additional products, we would keep this calculation going, having to compute the pounds we need for each of our products. So 200 plus 600 equals 800. The pounds we need in ending inventory, again, inventory control would tell us this, and they want 100 pounds left at the end of the period, so we need 900 pounds. We already have 50 pounds. So we will need to purchase 850 pounds at $4 per pound. So again, just waiting to the end to turn this into dollars. So total purchases for this would be $3,400. Let's go now to the labor budget, which is also very easily calculated. Remember that when we get our production in units, we use those production numbers to do the purchases budget, the direct labor budget, and we will also use units produced for the manufacturing overhead budget. For the direct labor, we need to know how many units we're producing. We go back to our production budget. We need to know how many hours that each product requires in terms of direct labor. And this one this product A requires 2 hours. This requires 3 hours. And then the rate of direct labor per hour is $12 regardless of which product that we're making. So we get $2,400 plus $7,200, a total labor budget for this period of $9,600. The subject for today in Module 13B, of course, is the cash budget. This is one of the most critical budgets that we prepare when we're going through the master budget. The reason it's so important is because the shortage of cash is a threat to all businesses, and particularly small and growing companies. If we do a cash budget, it's going to let us know ahead of time when we can expect a shortage of cash. Now, this is very important to know prematurely so that we can go ahead and work with our banks in terms of establishing some kind of credit line before we run out of cash. Secondly, the cash budget is going to highlight the periods of the year when we may have actual excesses of cash, and this can give us a little heads up and time to go ahead and decide what we want to do with that excess or extra cash. The other thing the cash budget is going to do, we're going to be looking at a cash budget prepared quarterly. Of course, you could do this monthly as well. But it's going to show you those quarters or those months where cash is particularly short and other periods where you have excesses. And this really exposes the cyclical nature of a business. There are very few businesses that have even sales throughout and thus even cash flow throughout the whole year. Many companies are cyclical. For example, a company that sells lawnmowers, they have a lot of business in the spring, but in the months of November and December, they're not selling many lawnmowers. So the cash budget is very good at exposing the cyclical nature of a business. Let's go take a look again at the flow chart that was included in the prior module where we see the different relationships between the budgets. We talked about this flow chart last time in terms of it starting with a sales budget and culminating with these pro forma financial statements. But today, let's take a look at the cash budget. And you can see that many of the other budgets are going to flow into the cash budget. And not only will these budgets that we've been learning to prepare flow into the cash budget, but over here we have the capital budget that we talked about a little bit last time. And this is the 5-year plan for the purchase of capital assets. And so if we plan to purchase, for example, new machines this year, then that purchase using our cash would have to be an input to the cash budget. So we see that it is really a focal point in this flow chart and that there are many, many inputs to a cash budget. The cash budget model is really quite simple. For each quarter, we want to look at beginning cash, and to that, we add all the collections of cash for the period, and this will tell us how much cash we're going to have available. From that, we look at all the cash disbursements that we expect, and we subtract that away from the total cash that's available, and this leaves us with an ending balance for cash. This ending balance, in turn, becomes the beginning cash for the next quarter or the next month if we're doing a monthly cash budget. So here you see a depiction of what I just described with the beginning cash. It always has to be estimated. And if you think about your budget year beginning on January 1st, this master budget or profit plan, as we call it, we'll be working on that in the months of August, September, October, November. And so someone has to anticipate that when the budget year begins on January 1st, they have to anticipate the amount of cash that the company will have on January 1st. So today we'll look at how we calculate these cash collections, and these come from our sales. So we see a direct link with the sales budget. For disbursements, we've talked about all kinds of things that the company is going to have to pay for, from purchases of materials to labor to SG&A. So there will be many different disbursements. So what we want to do is move from this very simple model to the model that encompasses all the complexities of a cash budget. What you see in front of you is what we call the comprehensive cash budget, and you would have had the opportunity to print this for yourself. But again, I'd like you to see the key areas that we just talked about: beginning cash, collections of cash, available cash, disbursements, and finally, ending cash. So we have, again, this basic model represented here in the more complex model. Looking at the beginning of this comprehensive cash budget model, again, the beginning cash will have to be estimated. And one of the things we'll learn to do next is how do we compute these collections from our sales. We all know that when we make sales that the cash is received over time. And so that's one of the things that has to be estimated, is how will we collect on these sales that we make. Let's look at 4 examples of how a company might collect from sales. Example 1, and again, that you should have a file of this in your D2L content area for this module. But example 1 is the most simple, of course, where this could be a produce stand, for example, and all the sales are made in cash. Let's look at example 2, where we get a little more complexity. This particular company doesn't do the cash sales. It's all on credit. And if you look at the second circle on the right, we're going to look at credit sales and how quickly these receipts come into the company. In this particular example, 70%, or the blue area, 70% would be collected in the quarter of sale, and 30% would come in the next quarter. And again, we could transition this easily to a monthly basis. Let's go to example 3. And in example 3, we have both credit and cash sales. So the circle on the left represents all sales with 60% credit, 40% cash. And on the right-hand side, we're just looking at those credit sales, and we're saying 70% is collected in the quarter of sale, and 30% comes in the next quarter. Now finally, and this is the example that really I believe is most common, and the one that we will be working with today as we learn how to do these calculations. Here we have a company with both credit and cash, but when you move to the right and look only at credit sales, we have 3 pieces of the pie, so to speak. 70% of the sales are collected in the quarter of sale, 25% in the quarter after sale, and the final 5% collected 2 quarters after sale. So as we learn to work problems where we have to do these calculations for collections, it's very, very helpful if we can draw or depict through these circles exactly how the company expects to collect on their sales. One thing that this particular visualization doesn't show you, what we can talk about, is perhaps what if this had said 3% in this green portion. Maybe there would be another portion that would be 2% that would say uncollectibles. And so sometimes we go ahead and build in the uncollectibles, but that particular section of, or that particular piece of uncollectability does not affect our calculations. We would just simply use the 3% or the part that will be collectible. In your lecture notes, you have some information about a company. We called it Company B, and we're going to use this information to look at how we do the calculations for any particular quarter or month for cash collections. And again, we are looking at these 4 lines on the cash budget and determining how we do this calculation. The information tells us that 60% of all the sales are on credit and 40% are cash. So this is the first step, is to be able to depict this in terms of our percentages, cash versus credit. And then concerning the credit sales only, which would be our second circle, we're going to have only 30% that are collected in the quarter of sale. Then we're going to be collecting 60% next quarter. And then the final 10% will be collected 2 quarters after the sale. What we're saying here in this particular circle is that it's really going to take 3 quarters for the sale of a particular quarter to all be collected. For example, if we sold something in the first quarter, it would take quarters 1, 2, 3 to collect all of the sales. If we were in for example, selling something in the second quarter, then it would take quarters 2, 3, and 4 to get it all collected. So in this particular company, what they want us to find is the cash that would be collected from sales in the first quarter of 2012. So this quarter be first quarter of 2012. So what we would do is we would look at the sales for this quarter, and in this case they are $60,000, and we're looking just at the cash portion. So 60,000 times 0.4, we would get 24,000. Now again, it says this quarter's credit sales, so we're still in the first quarter of 2012, and we have sales of 60,000 because we're still in the same quarter, times 60%, which represents the credit part. Now we'll move over to the 30% that's collected in this quarter. Now let's think about that. We have looked at, we're looking at the first quarter of 2012, and we've looked at what was sold this particular quarter. But we're going to have to back up to last quarter, which would be the fourth quarter of 2011. And that information is given to us as well. It says in that quarter, we had sales of 100,000. Again, our credit portion, this is still credit. All 3 of these are credit, times what piece? In this case, it would be, we're in the first quarter, we're looking at the fourth quarter of 2011, so we're in the 60% because we're in the next quarter. Now, finally, the fourth calculation we do is we have to back up one more quarter, which would be the third quarter of 2011. Let's look at the sales that we're told for that quarter, 80,000. We're still looking at credit. And we're going to take this last little piece. It was sold in the third quarter of 2011, but we are collecting for the first quarter of 2012. So we get $4,800, and when we add all of this up, we will be collecting $75,600 in the first quarter of 2012. These would be our collections. Okay, so this pattern would be set quarter after quarter. If we were in the second quarter, then we would have to back up to the first quarter and back up to the fourth quarter of 2011. So once you can do this for one quarter, it's very easy to apply this to the subsequent quarters as you compute your cash budget. Let's look now at the disbursements, which would be put in the cash budget as soon as we have our total cash available. We are ready to look at where is the cash going to go this quarter or this month. And the first thing we see would be the disbursements for purchases. And if we could, I'd like to come back to that after we go through these other items of disbursement, because this will require us to do a calculation, and we'll work on that shortly. We will have to be paying for our labor, so we return to our labor budget to get this amount. Every quarter we'll have a labor amount, and so we can easily input this to this line item on the cash budget. When we go to the factory overhead budget to get our cost and our cash payments here, what we have to remember is that one of the items on the factory overhead budget was depreciation. And because this is a cash budget, we do not want to include any depreciation. So we will go to the factory overhead budget, but we will pull out any depreciation. This will also be true for the SG&A budget. We must remember that there is no cash in depreciation, and the depreciation amount on SG&A would have to be excluded. Other items that we frequently see in terms of disbursements is we often see dividend payments, particularly in the fourth quarter. A company may decide to pay off a loan, so we could see loan payments or repayments. We also have talked today about the capital budget, that if this is the quarter that we plan to buy some new computers, then we will need to be dispersing cash for that. Another item you're going to have if your company has debt, which most companies do have, you will have interest payments. This should not be confused with loan repayments, because the loan repayment is a repayment of the principal, where here we're just computing our interest payments for the quarter, which would be 3/12 of the year. And finally, most companies are making estimated tax payments. Let's add the word estimated here. A company is going to project how much tax they're going to have to pay at the end of the budget year, and they will go ahead and divide that up into quarterly estimated tax payments. So that would be another disbursement. By the time we subtract all of our disbursements, we're at ending cash. And as it says below, this period's ending cash will become next period's beginning cash. One thing I'd like to say is that when we do a cash budget, and when these are done in the real world, they are not done one time. None of these budgets are done one time. They are done many times, and many changes are made, and edits and changes. So when you do a cash budget for the first time, it's very likely that you're going to run into negative cash balances. You're going to run out of cash. So don't be alarmed by that, because again, we'll be doing the first run on our cash budgets, and there will have to be modifications the company makes as it does the next version of the cash budget, and it will go through many versions before it's accepted. Let's take a look at the problem that you have again in your lecture notes for this module, and this is called Company C. And Company C is making purchases of raw materials. And when it purchases raw materials, this is what it does. 100% would be credit, and this is very typical. When we purchase materials or supplies from our vendors, we put it on account and pay it later. This example says that 30% is paid in the month of purchase. 30% in the month of purchase, but 70% is paid the month after purchase. Now again, this could be, Company C does the monthly budgets. This could be quarterly as well as monthly. This problem is going to ask us to find the cash payments for purchases for the month of May and June. So let's look at May. So what we're saying here is how much cash is going to be dispersed in May for these purchases. And let's look at May. We will have May purchases, and then we will back up and we will have to look at the prior month. Keep in mind, all purchases in this example are made on credit. That's very, very typical. And they are paid for within 2 months, as you can see, 30 and 70. So what we will be doing is for the month of May, we purchased $240,000. And we'll be paying 30% of that in May, $72,000. And then in April, if we look at April purchases, it was $200,000. And because we are looking for disbursements in the month of May, we will go back a month to April, we'll multiply by 70%, and we will see that the amount of cash to be dispersed in May is $212,000. 30% of May's, 70% of April's. Let's look at how we would do this for June. June disbursements for purchases is we would go with the June purchases and we would back up to May. In June we purchased $210,000 times the 30% because we're looking at June disbursements and we're looking at June purchases, $63,000. In May, we back up to May, it was $240,000 times 70%, which is $168,000, and we end up with a total of $231,000 that will be dispersed in the month of June for purchases. So what we've done today is to take a look at the cash budget and look at all the components that feed into the cash budget. I'd like to say now that these types of budgets are done typically using Excel and are very interrelated. We would take those cash budget cells and you would see formulas where all the numbers that we're needing to do the cash budget are going to be feeding into the cash budget from some other budget or from some other input information. The cash budget, again, is a really critical part of the master budgeting process. It is a very helpful tool for management to make sure that they don't unexpectedly run out of cash so that they can anticipate times of excess so they can make appropriate investment decisions. And as we said earlier, the cash budget itself will indicate the cyclical nature of a business and let us know when we're going to expect to be short of cash and when we can expect to have more cash than we actually